Hey, what's going on, everyone? Christian Carter from Radius, and today we're talking about adjustable rate mortgages. We're going to do a huge breakdown of what adjustable rate mortgages are all about. On the left side of the screen, you can see we have some key definitions that we're going to define and talk about. And then, of course, because I love examples, on the right side of the screen on the board, we're going to go over a quick example. All right. All right, so let's dive right into it. First off, we have interest rate, and there's three things we want to talk about when it comes to the interest rate, right? You've got your initial rate, you've got your index, and then you've got your margin, right? So the initial rate, sometimes this is referred to as a teaser rate, but the initial rate is basically the interest rate that you will be paying on that loan for the first couple of years, however long that adjustable rate is fixed for, right? And it is called a teaser rate because that interest rate is going to be slightly lower than a fixed rate, right? And this can vary. Sometimes it's 0.25% lower. Sometimes it's over a point, a full percentage point lower than a fixed rate, but it can vary. But just know that initial rate, that's only fixed for a certain amount of time, right? So next up, we have the index. So all adjustable rate mortgages are tied to some sort of financial index, right? Whether that's the LIBOR, whether that's the prime rate, whether that's the SOFR, which we're going to talk about over here. But just know that every ARM, adjustable rate mortgage, is tied to an index. And basically that index is just kind of a barometer of the current economic conditions, right? Next up is margin. So every lender is going to have a margin built in to an adjustable rate mortgage, right? And essentially the margin is saying how much of a percentage point, how much basis points you're going to pay for an interest rate over the index, right? I hope that makes sense. So you take the index, and then let's say the lender has a margin of like plus 2%. So you take the index rate of, let's say, 5%, margin of plus 2%, your real rate will be 7%. Don't worry, we're going to go over it in the example. All right, adjustment periods. These are very, very, very important. So you've got two main adjustment periods. You've got the preset interval, right? And then we've got the initial fixed period. So let's talk about the initial fixed period, first of all. You see in this example right here, 5-1 ARM. So the initial interest rate on this 5-1 ARM, the initial fixed period would be 5 years. Meaning for the first 5 years of the loan, your interest rate is not going to change, right? However, after that first 5 years, there's going to be some sort of preset interval of when that rate will start to change, right? So the preset interval in this example is the 1 right here. So again, with a 5-1 ARM, the interest rate is locked for the first 5 years, and then every year after that first 5 years, the rate is going to change, whether up or down. Okay, so adjustment periods, very, very important. Next, interest rate caps. So you've got an initial cap, you've got a periodic cap, a lifetime cap, and then it's not really a cap, but we like to call it a floor rate, right? So initial cap, right? That essentially says that when your adjustable rate mortgage is going to change for the first time, it can't go over a certain amount, right? It can't go over a certain initial cap. And this is to try and help the borrower from what's called payment shock, right? So if we go back to this example, the 5-1 ARM, if it's locked for the first 5 years, like that example, and then rates, shoot up, I don't know, by 12 percentage points or something like that, there's going to be an initial cap built into that first adjustment period so that you're not paying an exorbitant amount after the initial fixed period. And then you have a periodic cap, right? So a periodic cap essentially says, it can't go up by more than X amount during the preset intervals, right? Which on this example is the 1. So essentially a periodic cap, same thing. Not the same thing as initial cap, but it's just saying that every time the interest rate changes, it can't go over a certain amount. And then of course we've got lifetime cap. I'm sure you're picking up what I'm putting down as far as this. So a lifetime cap it basically says over the life of this loan, even though it's an adjustable rate mortgage, it can't go over a certain amount. Now, because lenders all like to make money, right? We also build in a floor rate too. So let's say you get an interest rate right now, even if it's adjustable. Let's say it's at 7%. The lender might say, hey, no matter what, it can't. We're not going to honor a rate that goes below 4%, right? So there's a lifetime cap, but there's also a floor rate. So no matter how low interest rates fall, your adjustable rate mortgage still can't go below whatever floor rate is set by the lender, right? All right, last up here, we've got amortization, terms, features, etc. So essentially, this is just things to be aware of. So duration of the loan, adjustable rate mortgages, they're not just for 30 years or 15 years. You can get these in any variety, 5, 10, 15, 20, 25, 30 years, right? So it's similar to the fixed world as far as that. And then another feature that you might want to be aware of is your ability to convert to a fixed loan. And what I mean by that, you got to look at your loan documents, but there might be verbiage in that loan document that essentially says that at any time during the life of the loan, if you want to, you can convert it to a fixed interest rate. So at least you can budget better. You can know what your monthly payments are. But again, good thing to look out for and a good thing to look in your loan docs for. And then prepayment penalty, again, just overall, just good sense to look into your loan documents and see if you do or do not have a prepayment penalty. Prepayment penalty is just like it sounds. If there's no prepayment penalty on the loan, that means you can pay off your loan at any time without a penalty. Pretty straightforward. All right, so let's go into a quick example, right? So again, just to set some ground rules here, we're going to use a 5-1 ARM, right? Meaning it's fixed for the first 5 years, and then it's going to change every year after that initial fixed period. We're just going to use a $300,000 loan, and this loan is going to be amortized over 30 years, right? So it's a 30-year adjustable rate mortgage. Again, we need some ground rules here. Our initial rate is going to be 5.75. Our index is going to be the SOFR. Our margin is plus 2%. The initial fixed period, again, is 5 years. The adjustment period is 1 year. Initial cap is going to be 1%. Periodic cap is going to be 2%. Lifetime cap of 5%. And then a floor rate of 3%. All right? Stick with me because this is a good example. All right, let's talk about years 1 through 5, right? Your initial rate, right, like we talked about, right there, is 5.75%. So even though the SOFR is at 5%, we have an initial rate of 5.75%. That makes our monthly payment $1,750. Now, for the first 5 years of this loan, that payment is not going to adjust. And one ground rule I forgot about: we're just talking about principal and interest here. No real estate taxes, no homeowners insurance, nothing like that. So just principal and interest. Again, for the first 5 years of your loan, that payment is not going to adjust at all. All right, let's go into year 6. So year 6, the SOFR bumps up to 5.5%, right? Now we know our margin is plus 2% and it's based off the SOFR, right? So our fully indexed rate should be 7.5%, right? Because the SOFR's at 5.5. The lender has a built-in margin of 2%, so our rate should be 7.5%. However, remember we talked about, where are we at here? Initial cap. Remember we talked about initial cap of 1%. So because we have that initial cap of 1%, even though we should be paying 7.5% in an interest rate, that initial cap helps us to make our actual rate 6.75%. I hope that makes sense, because our initial rate when we got it was 5.75%. Rates went up a little bit, but we did have that initial cap of 1% to help us right here. So when it changes for the first time, when that adjustable rate changes for the first time, our new rate is going to be 6.75%, and our payment is going to go up to $19.45 per month. All right, let's talk about year 7, right? So the SOFR stays at 5%, right? It hasn't changed at all. So our fully indexed rate should be 7.5%. Again, because the SOFR is at 5.5, we have that margin of plus 2% built in by the lender. So that gives us our actual rate of 7.5%. Now again, here, we don't have any sort of protection from an initial cap standpoint, right? Because we've already used that. And our periodic cap is set at 2%. So we're not protected there at all. So our monthly mortgage payment will go up to $2,097 per month. All right, now let's talk about year 8 right here. All right, we're going to talk about 2 extreme scenarios, right? One where rates skyrocket, the other one where rates plummet, right? So first one, let's say in year 8, interest rates absolutely skyrocket, right? The SOFR goes up to 12%. So it went from 5.5% all the way up to 12%. So our fully indexed rate should be 14%, right? However, we do have that lifetime cap, thank God, of 5%, right? So that makes our actual rate that we're paying 10.75%. Because again, look, we had our initial rate of 5.75%. We had a lifetime cap saying that the interest rate could not go 5 percentage points above our initial rate. So even though we should be paying 14% in interest, we're only paying 10.75%, which brings our payment to $2,800 per month. Now let's talk about the exact opposite, right? Let's say in year 8, interest rates absolutely plummet, right? And the SOFR is all the way down at 0%. Again, these two are extreme examples, but I'm trying to prove a point here. So the SOFR goes down to 0%. So our fully indexed rate, 0 plus the margin of 2%, should be 2%, right? So we should be paying on a very, very low interest rate. However, we have the floor rate built in of 3%, which basically says our actual rate is 3% because the lender at the beginning said, look, we have to put this floor rate in here. No matter how low interest rates go, it can't go below 3%. So the actual rate of 3%, that would be $1,264 per month. So I hope that helps. I know we kind of went over it quickly, but if you guys have questions or anything like that, please reach out to me. And of course, if you guys have questions on other videos, I need those suggestions because I love making these videos. Other than that, have a great one, and I'll see you later.